Got it. Of March 7th, 2025 to order. We got an agenda before us. Welcome all guests. You all want to introduce yourself, Mike?
Mike Baldwin with Jefferies. Good morning, Doug Draper with BofA.
Hey, Doug.
Andrew Devbeck with RBC Capital Markets.
Okay.
Rick Patterson with Raymond James.
Hey, Rick. I think we got some folks on the phone, don't we also?
Yeah, for the folks that are on the phone, we have Jonathan Kern from Siebert, and I saw Tom Kai. He's with Bank of America, that's what I thought. I just read all the proposals, now they're all blended in my head. And Frank Lito from JP Morgan, and there is somebody dialing in from area code 954, if you could let me know who that is.
It's Broward County.
Okay, so whoever's on the phone in area 954, if you could send me a note afterwards, then I can add you into the minutes to record that you were here. And we have several people from the school district. I won't introduce all of them. It's my team that are all on the line.
I'm going to start here around.
Oh, sorry, Bill Moore, Finance Committee member. George L. Moore, Committee member.
Jack Warner, committee member.
Alden Mars, Committee member.
Michael Koner, committee member.
Look up here.
Richard Pengelly, PFM Asset Management.
Leanne Evans, treasurer. And for the group, when you want to speak, you have to press the button and watch for the red ring to come on right around your mic. That's how you know the mic is on, because you may press it and it doesn't go live, but that's the trick to the microphones.
Laura Howe with PFM Financial Advisors.
Omar Charbanu, PFM Financial Advisors.
Patricia Morales with the Office of General Counsel.
Kristen Vara Garcia, Office of the General Counsel.
Thank you. Are you new down there in the end? Have we seen you before?
Yes, he has. He's with PFM on the debt side, so he's working with Laura Howe.
Okay, nice to meet you. All right, so welcome to all. We've got an agenda for approval. Motion for approval of the agenda.
So moved.
Your second. Any opposed? Agenda's approved. Next item is the minutes of December 6th. Is there a motion?
So moved.
Second. Any opposed? And then we go quarterly investment reports. Leanne?
Okay, good morning, everyone, and thank you all for being here. It's great having the full, all the committee members here. Welcome back, and we haven't met since December, so Happy New Year. We're going to let Richard Pengelly from PFM Asset Management kick us off with a market update, and then roll right into the quarterly investment report from PFM. So Richard, if you want, I can get you to the right page if you tell me where you want to go, and then you can drive from there.
All right. I think we'll start with the sort of the summary and try and make sense of where we are with things. We, from the last meeting, we knew that post-election and going into the new administration, as they started implementing their policies, we expected, some volatility this year, and that's exactly what we've gotten. I think as a general matter, the current conditions look good, continuing from 2024 at the beginning of the year here, and really from where we are here going forward, it's trying to assess what the potential impacts are to the different policies as they get implemented. So, looking at, tricky to navigate. Yeah, so, looking at the two key metrics that we've been, hyper-focused on for the past 2 years, inflation and the labor market. Inflation, we made big gains at the initial part of the Fed's fight to bring inflation down. And over the past year and a half, it's generally been fairly sticky as the Fed has been trying to get down to that 2% target. Here we show the November core PC at 2.8. The most recent reading was 2.6% for January. So they still have a little while to go, but based on their projections, they really didn't anticipate getting down to that 2% level until 2026 and maybe now more like 2027. So really what the Fed is looking for is a general movement towards that level, and that's what we have seen. The unemployment rate, which is the other part of their mandate, making sure that there's full employment, that continues to look, to be on target. Here we're showing that November was 4.2%. The most recent reading was 4% for the unemployment rate. So they're pretty much at full employment, and their projections are that the unemployment rate will stay in this range. Maybe pick up a little bit higher, maybe another tenth or a couple tenths of a percentage point higher, but generally remain low and contained. So, the big story is what's going to be the impact from the administration's policies, and there's a little fine tune on this. And then there's really four key things that we're looking at. How will taxes impact the economy, tariffs, immigration, and regulation. So following the election, the markets generally took these four things in balance and said, if I look at taxes and deregulation, that's going to be very positive and potentially outweigh the negative impacts of potential tariffs and impacts to the labor market from a shift in immigration policy. We saw a big run-up in the stock market. So, now that the administration has come in place and we're actually seeing these policies play out, we're seeing more of a fine-tuned reaction to the different things. The tariff announcement, the on-again, will they, won't they tariff story, as that's played out, you've seen markets whipsawing around the uncertainty on tariffs. Generally, tariffs are expected to be to raise prices, potentially being inflationary to the extent they go in place. As we've seen even in the past week, the tariffs have get announced, then we see a rollback. So in the short term, the view is that the tariffs really will be more of a negotiating tool. The way they've been laid out from here is that the current tariffs are about border security. The administration has initiated a study to see, what the tariff disparities are among different countries. And then in April 2nd, that report will be delivered. And at that point, we'll have a potential shift in the implementation, the administration's implementation of tariffs. So we're really potentially just at the beginning of this story, and we're already seeing sort of the impact that is having on the markets. On the deregulation front, DOGE has been going through and sort of slashing jobs and making a big impact. To date, despite the headlines around layoffs, the overall impact on the number of jobs, that will potentially be impacted directly at the federal government level, probably won't have the biggest impact on the unemployment numbers. Total federal workforce is a little over 1% of the overall labor market. So although the headlines, we've seen a lot of headlines, the actual numerical impact potentially is not big. But secondary impacts, as they work through the economy, could be bigger. I think in January we had the biggest number of layoffs, 174,000, that we've seen since July of 2020 during the height of the COVID layoffs. So, but again, the overall impact is not expected to be big just on the numbers.
What about efficiency,
Meaning,
the operations of government, the functions of government?
right, right. Well, so it'll take some time to sort of see that, that really play out. So a lot of these things have been hard to model, going back to the tariffs, for example, and, a couple of people from the Fed have come out and said this. Even if the tariffs do get implemented on a particular country, you don't know what the exporting company is going to do. Are they going to absorb the cost or pass it on? What will the importing company do? What will the retailer do? So it's really hard to model how a particular tariff flows through, and then you have to multiply that through, multiple different companies and industries. So a lot of these policies will really take time for us to see how they play out. Next slide. So looking at the outlook, at least in December, the outlook was very different than what we'd seen going into the past, I'd say 2 to 3 years, where really the forecast was sort of the same. Things look good right now, but the second half we expect a recession, right? So going into 2025, we have a different outlook, which is good growth, not as strong as 2024, and really consistent throughout the year. That's probably moderated over the course of the quarter, where the uncertainty around, particularly the tariffs, have pulled back the potential spending from consumers and also business investment. So although we continue to expect that growth will be positive generally for the year, it's expected to be slower than we were initially projecting for the year. Next slide. I'll jump to sort of the Fed's last forecast and sort of contrast that with what the market is looking at now. In December, when we got the last forecast from the Fed, it was projecting that it would have 2 cuts in 2025, another 2 cuts in 2026 for a full percentage point cut by the end of 2026. They'd also raised the expectation for the neutral rate, which had sort of been increasing over the past year. The last projections, they thought the neutral rate would be somewhere around 3%, up from 2.5%. So potentially a little bit hotter economy in the long run. The markets right now had been in line, if you look at Fed funds futures, with that 2 rate cuts, with the first cut coming sometime in June. Now that's increased over the past week, and we're starting to see more leaning towards as much as 3 cuts or 0.75% in rate cuts in 2025. So we expect, again, some volatility around that expectation as we go through the year, but the expectation for the next cut or the first cut for the year is sometime in sometime in June.
I mean, you were showing 2.8, but January was actually about, a lot higher than that. On when's the next one, the 12th, coming out on March for February. Do you have an idea what February CPI is going to look like?
So we showed, the last number was 2.6% for CPI. Is that, you're talking about core?
Well, I thought it was much higher in January than that. I thought it was like 3.
For CPI?
Yeah.
Yes. Yeah.
So idea of what February may look like. Like, what's the Fed's going to do as the inflation it bottomed, now it's coming back up. So you got jobs slowing down, and you've got inflation still around. So can they do their rate cuts?
Continue with their rate cuts? Well, I think their expectations, we're going to see some variability and volatility in the number, and that's expected, right? But the Fed, the Fed thinks the neutral rate is 3%. If the overnight rate is at, 4.25 to 4.5, they are constraining or view that they're constraining the economy, and that there will be these blips along the way, but that they would, continue to stay the course. They lowered interest rates by 1% last year. It'll take some time for that to really take a hold and take effect. So they're probably not going to react immediately to, even if we see another month of increase in inflation, because they expect it's going to take some time for it to work through. This pause is sort of that time to sort of see how the inflation numbers play through before they move. So I don't think they would react to, even if we did see another tick up in inflation, if that makes sense.
Tariffs? Due to tariffs that the inflation's having?
Potentially having an impact, yes. Or even the expectation of the tariffs having an impact. One of the things that we've or seen or expecting is that as consumers are expecting tariffs to go in place, that they're speeding up spending and doing more buying, which would also put some pressure on inflation.
What about other countries besides U.S., Canada, Mexico? What's the potential there, China and other countries?
For more tariffs? Yeah, well, when we get to April 2nd, right, that's when we're going to have the full study and the tools necessary to do more broad-based tariffs around the world. So the other, kind of moving into to markets. So we saw rates had been inverted for quite some time, and we started move towards being uninverted in the fourth quarter. On the longer end, there again, the expectation of the net policies being pro-growth and there being some inflation associated with it, pushed up longer-term rates. Also expecting that with tax cuts and potentially more spending, that would also drive increased deficits. We did see longer-term Treasury rates increase, contributing to the uninversion, or uninversion. Yeah, I said that right. So, so that was positive for returns in the fourth quarter. The other sort of factor we saw, I'm going to skip through those and then come back. The other factor that we saw was a tightening in credit spreads. So, corporate spreads, asset-backed security spreads, all tightened up throughout the course of the year and the quarter, which contributed to returns. So, where we are now, given the uncertainty around what's going on with the policies and also the relative tightness in spreads, we're generally being very cautious in the portfolios and very selective in the industries and particular securities and names that we're purchasing. To the extent we see an increase in spreads, then we we'll cautiously buy corporates into the portfolio, but we're going to be slow or generally underweight relative to what our targets would be in those sectors.
So government instead of corporate?
Yes, so you're going to see our Treasury and agency allocations higher. But for the fourth quarter and for the calendar year, returns again were strong given that tightening in the spreads in those sectors over the course of the year. So with that, I'll jump into the portfolio itself. I'll stop here. Portfolio was, in compliance with your policy requirements. Here we see a snapshot of the long-term portfolio. We're pretty much right on top of the benchmark for the quarter. If you look at the effective duration, 1.71 and 1.74 years for the benchmarks, basically right on top of it. And like I said, as I mentioned, you know, we're going to be very selective in the names that we're buying in the, you know, corporate portion of the portfolio throughout the year. Returns were good for the calendar year. Given there was a increase in Treasury yields during the fourth quarter, the absolute return levels were, you know, basically flat for the quarter. You did outperform the benchmark by, you know, 20 basis points and by 45 basis points for the calendar year. So I'll pause there. Questions?
Any commentary on?
Okay.
My turn?
Yep.
Okay, I will pull up the district's summary report, and as you know, it contains a lot of the same information that PFM just reviewed, that Richard just reviewed, but I have a bit of a summary. Total portfolio is at $3.2 billion as of the end of December, and that's really our high point. Bulk of the property taxes come in December, some in November, but December is really our high point, and then cash goes down from here until next December. It's pretty cyclical. Currently, there's very small amount in cash that's related to the schools. The schools' money is all in cash. We have money markets in local government investment pools and securities. So 51% in money markets, 48% in securities. We spent a lot of time talking about how much to invest in securities with the uncertainty in the interest rates. You know, what is it going to be? Is it going to go up? Is it going to go down? When is cash coming in? And it was also tricky to get securities. You know, there's not as many of them as we'd like. So we're more in money markets and pools. The returns there are really good. And as you know, I'm still on the investment advisory committee for that local government investment pool that we have some money in. So I'm very involved in that and monitoring what they're investing in. So I'm very comfortable with the breakout that we have right now. Went over the core portfolio. Richard already did that. The investment earnings, you know, we started a new year, so we're at $53 million so far versus $41.2 million for the first 6 months last year. Let's see. It is. We got a little chart down here I like to look at. So the green line is last year, and the dotted line we always use for the current year. So the slope is a little slower. So I'm curious to see, I'm guessing that line may cross because interest rates have come down a little bit. So I think our total interest earnings, while it's higher right now, by the end of the year, I think it's going to be a little less than it was last year. We'll have to watch and see how that plays out. Sales tax collections, I'm going to skip that because I've got the normal sheet at the end of this presentation that I'll go through. The portfolio returns, we just went through that. The index for the short term is at 4.59, and then you'll see Florida Palm is at 4.66, Florida Prime is at 4.7. The short-term portfolio is at 4.35. And this is really why we wanted to talk about that new benchmark that we talked about last time. The next thing we're going to look at is the logic behind that. But this is really why I want to make that change. This rate is an overnight rate, and it works great when you're comparing it to pools and money markets. It doesn't work well with the short-term portfolio because you still have that slightly inverted yield curve. Once the yield curve completely normalizes, that's going to be great for us because we'll always beat it. But I don't know that it's a good benchmark. I think we should have something that's more realistic for what we're investing in. So that's why we want to add a third benchmark. And we'll go through that next. We have a slide deck to explain what we did. Let me do this. This is the same information that we saw that Richard did, except this is looking at all of it together, not looking at one portfolio versus another. So it shows the cash that we have. That $34 million, most of that is in our schools, the schools' bank accounts. We roll that up as part of our portfolio. And you can see the schools, it's actually broken out. $33 million of it is in school bank accounts. Then money markets and pools and securities. This is looking strictly at the investment portfolio. And this is the money that's at Bank of New York as our trustee for our debt issues. So we're tracking all of it. Technically, our investment portfolio does not need to include this. The policy really focuses on our investment portfolio, but it's still cash, and it still needs to be tracked. So I show it, it's a good way for me to keep track of what we're doing too. This is just another way of looking at what PFM presented, so I'm going to skip over that. It's what we've already done. This is our projections of where we're at, and I know that's a little, it's hard to see. The light orange is short-term investments, and you see as things mature, that will shrink. And just like it did last year, by September it was gone. It brings up in December, and then by September, it's probably going to be down to nothing. We spend those down. We typically let those run till maturity. And I'm not going to go through all the individual securities, but I'm going to skip through these and bring up the sales tax report. This is as of December 31st. So this is revenues that were collected through October. And we were at 129% of our projection. We've collected $1,321,000,000 versus the $1,345,000,000. I've already gone and updated the revenues through February, and in February, we did cross over and have collected the full $1.345 billion. Palm Beach County is taking an item to the Board of County Commissioners to rescind the sales tax resolution, which is what we expected. We are going to sunset it. It will end a year early, which is what we had forecast. And the new sales tax that was approved by the voters in November will pick up in 2026, so they'll dovetail. That does mean we'll have taxes collected. The Department of Revenue will only end a tax at the end of a calendar year. So it will run through the current year, and we will collect some more money, which is really helpful because we have experienced cost escalation of those construction projects with the tariffs. I was at the Construction Oversight Review Committee. They were talking about the tariffs as well. What is that going to do to cost of construction, to purchase steel, to purchase concrete? We experienced all kinds of shortfalls and price increases during COVID. We're going to see some of that, not necessarily shortfalls, but price increases with the tariffs if they're implemented, if they're rolled out. So it's something they're paying a lot of attention to, and so am I. I want to make sure that we complete all the projects on that referendum list.
Then,
Mr.
a quick question. We were only collecting a half cent from the county tax, right?
Right, we got a half penny of the full penny.
Now it's a full penny.
It's a full penny right now. That's what it's always been. We got a half penny. The county got 0.2 and the cities got 0.3. So it was shared between the county, the
Yeah.
cities, and the school district. In 2026, it will switch to where it will just be a half penny. So we'll go from.
Just a half penny for
Right,
us?
because it's only us. We're the only participant
Yeah, I
in the
know.
new sales
I know,
tax.
yeah.
Yeah. So we'll go
It stays
down.
the same.
Yeah, your sales tax through the end of 2025 is going to be 7%. It's going to drop to 6.5% in January 26. Mr. Koner, I saw you had a question. Nope? Okay. So this does go through. It also shows the interest earnings net of the fees that were associated with that line of credit that we had back then is $59 million. And we have used some of that for projects already. I still have some of it set aside. It's going to be used to make sure we can finish all the projects on the referendum list. If we end up with extra money at the end, and I don't know if we will or not, but if we do, we would use it to make debt service payments on projects that were on the referendum list. But we'll bring that to ISOC, to the Sales Tax Oversight Committee, when that decision is ready to be made. Okay, so that's the end of that report. Are there any questions on the investments? Okay, then we're going to go on to talk about the new benchmark. And I'm going to let Richard walk through this. When we talked about it, I called him saying, I think we need another benchmark. I think we need to break out our short-term portfolio versus overnight and have benchmarks that align with what we're investing. And so I asked PFM to do an analysis to prove that I was right in my thoughts, and I was. But I want to see this is the analysis that the committee asked for at the last meeting, so we're bringing this back to you.
Just go to past the summary to the benchmark sort of history.
Okay? Oops.
Yeah, is there some way we can get the screen to be brighter or the lights to be dimmed a bit?
It's very, for old people, it's difficult to read.
Hang on. The
Speaking
people,
for
the people
myself,
that
not
manage
for
the
anybody
lights
else.
and everything are right behind
George,
us.
you're exempt.
Don't stare at the lights.
Dim some of those overhead lights. Okay. Is that better, or does it need some more?
Well, more.
Yeah, do it, can you do it some more?
Well, a lot more.
They're saying a lot more.
I-
Is that better?
It's improved, but not optimum, let's put it that way.
And then the lights are new and they're very bright.
There, he did something, wouldn't
Oh, it got
Maybe
better,
these
then it got
guys
brighter
up here
again.
would be.
Would you like my sunglasses?
No, it's fine. I guess I just have to get a chair and sit up front.
And we can see if we can rearrange the room for future meetings. This is a
Okay.
standard way. Either that,
Oh, dwell on it
or
anymore.
we can also bring back the laptop so you have it in front of you and can scroll along.
Yeah.
Okay.
And since we're helping you with the formatting, is there a way we could get each page so we could see the entire page on the screen?
Yeah, I'm trying to,
Having the bottom cut off is disconcerting for me. I don't have the imagination, I guess, necessary.
okay, there we go.
All right.
Excellent, thank you.
Thank you very much.
Yeah, so, I think Leanne sort of already described what trying to target here. Up until this point, there were two benchmarks. One benchmark was an overnight benchmark, the Standard & Poor's or S&P Government Pool Index, which is all overnight funds. Then we had a longer-term benchmark, which was from 1 to 3 years. And then everything that was short-term was benchmarked to that overnight benchmark. So, in a normal upward sloping yield curve environment, when you look at all of the short-term investments together, they look, positive relative to the benchmark. But when you get into an inverted curve environment, it sort of starts to stick out that the longer-term part of the portfolio between overnight and 1 year is mismatched with that overnight benchmark. So we went back and did an analysis and say, well, what is that short-term portfolio's duration on average? Because that's going to determine what would be the appropriate benchmark. And it, varied between a little bit less than half a year and when it's spent out at times, down to zero. But on average was about 3 months, 0.25 years. The actual calculation for this little over a 10-year time period was 0.23. So when we look, that exactly lines up with, let's see if I can go to the next page, essentially lines up with the 3-month Treasury bill. And so that makes sense to be the appropriate benchmark for that portion of the portfolio. So you'd have 3 benchmarks for your overnight funds, the overnight LGIPs, the money market funds. You would use the S&P GIP index as you do now. The short-term portfolio, which is laddered fixed income investments, would be benchmarked against a 3-month T-bill, and then the longer part of the portfolio would continue to be benchmarked against the 1 to 3 year Treasury index.
I mean, this stood out because of the inverted yield curve, but in reality, we've had an overnight yield curve that we've been using to measure that, what I call short-term portfolio, which we always exceeded it. It's a great, it looks wonderful for my reports, it's great. And I didn't even think about it until it flip-flopped and realized that we really should have another benchmark that really proxies what we're investing in. So, fixing it a little late. I wish I'd fixed it a long time ago, so we wouldn't have had the mismatch when the inverted yield curve. The yield curve is becoming more normalized, or it looks like it's heading in that direction, but it's still a better tool when we're looking at it. So I want a true good measure that we can use going forward. So if the committee's okay with this, this is the change that we proposed in the investment policy. And I'm going to be taking that to the board. We've got a process that the district is going through to review all the policies. And I'm hoping to get that through this year, but there really is a long list of policies going to the board. So I'm probably going to start measuring against it, but technically, I need to follow the old way until the board approves that policy. But internally, I'm going to start laying things out because we're going to break it when we're tracking things. We currently have two portfolios. We have short-term and core. I'm going to add an overnight portfolio and then short-term and core and just make sure we have the right benchmarks.
This is the overnight?
No, this is going to be the short term. The 3-month T-bill would be the short term. Typically, in December, tax revenues come in, we're buying securities, and we buy them anywhere from 4 months out to a year, and then we let them mature. They're laddered out. We don't sell them, we let them ladder out, let them mature. So what this chart did was show, how the average portfolio, and that average over any given year is, it's 0.23. And that's the reason PFM, and I asked them to do the analysis, what is the appropriate benchmark? So while in December, we have things from 4 months to a year with an average of probably 6 or 7 months, it rolls down as time goes on and it gets down to 0. So that's where they're coming up with an average of 0.23, which is aligning with that 3-month T-bill that we'll use for these short-term investments. The overnight portfolio, that's money markets and local government investment pools, and what little we have in cash, is going to be measured against the S&P LGIP 30-day index. So I think we're going to have them all have the investments matched up with the appropriate benchmark going forward. Any questions on that?
What you thinking, Peter?
Yeah, we're absolutely in agreement. That's, the numbers line up, correctly for us. And given the size, of that short-term portfolio, it makes sense for it to have its own benchmark.
Got a lot of money.
That's a lot of money.
Okay, so I didn't bring it up, but in board docs, under this agenda item for the benchmark, I do have the investment policy that I brought to you back in December. Let me open that up real quick. And somewhere in here, the chances of me quickly finding this, oops, right up there. Nope, those are comments. But it does, I've added a section in here on the new benchmark. This is all the securities. Oops. Sorry, I know I went past it now. You all have seen this before, but I want to make sure, okay, I passed it? No, that's derivatives. Go down? Sorry, it's tricky to do this on the screen. Performance measures. So we've added in, the original one in the bank accounts will be compared to the S&P GIP index. And then the short-term funds would be the 3-month T-bill index. And then we'd still have the investment performance for the core with the Bank of America Merrill Lynch 1 to 3 year government index. So we'll have 3 indices for the 3 portfolios.
What do you do with that?
With
We can look at it, but what do you do?
Well, this is the policy, so this policy will go to the board to be approved. What will happen in reality is we're going to go back to this report, and at the beginning, it would show up in PFM's report too, but in this report, right at the beginning, I'm going to have, currently we have a core portfolio and a short-term portfolio with a benchmark. I'm going to add an overnight portfolio. This benchmark will be used for the overnights, and then you'll see a new section that is for the short-term portfolio. And we'll be comparing that 3-month T-bill rate to this short-term PFM portfolio. So this page will change. We'll have another box. And then PFM will be using that index on their reports as well. And you'll be comparing the performance of the portfolio to a benchmark that aligns with the average maturity of the securities. I think it holds us more accountable. It's a better benchmark for what we're investing in.
Sure, yes, indeed. No, I'm quite content with it.
Anybody else?
Good.
Yeah.
Okay, I'm going to take that as a unanimous approval. Okay, thank you. So the next thing we want to go to, if I can find it, well, I'm going to bring up board docs. I wanted to give you some updates on contracts. At the last meeting, in the discussion section of the meeting, I mentioned that we were getting ready to negotiate new contracts with our bond attorney and disclosure counsel, and we were doing an ITN for underwriters. And we were in December, and I said that ITN was going to go out in the street in January. It did. We got proposals in, and we've scored them, and we have selected a new team of underwriters. This is the results of that report. We are shrinking the pool from 11 to 6, which is better. It's more appropriate for the number of transactions and the size of the transactions we're doing. The senior managers are Bank of America and Raymond James. And then the other co-managers, and these are, I'm just going to go down the list, Jefferies, JP Morgan, Morgan Stanley, and RBC. So we'd have a team of 6 underwriters. This is, we are lining this up to go to the school board at the April meeting. I think that's a good group of underwriters. They're a great team. Some of them are here, some of them are on the phone. We are pleased with the results of the ITN. We did change that ITN a little bit, as I mentioned. I went back and listened to the last meeting to make sure I was saying this correctly, but we went through and added some targeted questions in to make sure we were getting underwriters that had experience dealing with Florida cops, which is our primary function. That's why we borrow money. So if you have, and there are great underwriters out there, great firms that do GO bonds, but they don't deal with cops. And cops are a unique animal. It's a lease purchase agreement. It's not the same as a bond, and it's different investors. It's got a different rating than our normal rating. We have an underlying rating, and then we have a COPS rating. So there's some different things with them. So we tried to tailor, and we worked with PFM financial advisors. Laura helped with that, to tailor the language so that we would end up with a team of underwriters that really have experience with the transactions we do. And Mr. Moore, you talked about that specifically at the last meeting, and we took that to heart. And this is the result of that underwriter selection process.
Can I just ask a question?
Sure.
We have six managers now, two co-senior managers and 4
Right.
co-managers. These other, we've got the other people
Other
are-
firms were not selected, so they're not part of the team.
Fine. Well, I commend you, frankly, for reducing it to a group of people who have really some
Right.
skin in the game, as it were.
And-
I mean, let's face it, we need
Right.
to have people who are focused on serving our needs rather than
Right.
satisfying.
And if we determine that we need to do a TAN again, we didn't do one this year, and I don't know if we'll do one next year or not. But when we do things like TANs and some of the other transactions, not COPS or COPS refundings, those go out, and any bank can participate in those. If they're competitive sales, we don't limit them. So other firms that want to be underwriters, but they didn't make that team, could participate in some of those other transactions, and that has happened in the past. And we're going to talk more about underwriters and how we're going to rotate between them in a couple of minutes. Laura's got that in a presentation, but I just wanted to cover the award of the contracts first. So that's the underwriters. The attorneys, we did negotiate with them. I worked with Kristen, who's at the end of the table. She helped us with our attorneys' contracts. We negotiated directly with Greenberg Traurig and Neighbors Giblin Nickerson. Greenberg Traurig is serving as our bond counsel, and Neighbors Giblin Nickerson is the disclosure counsel. So they work with us on the offering statements and the legal documents, resolutions, and so forth for any debt issues. So that's going to the board next week. It's going in March. The underwriters are going to the board in April.
in the case of the underwriters, are the books rotated between the managers or
Oh, and we're
or
gonna
the
show
senior
you-
managers?
Yeah, we're going to show you that in just a minute. We've got some other slides. That's the next thing on the agenda, is to walk you through that, because I want you to see it.
I'm just curious.
Yep. Any questions on the contracts? And if you're interested and you want to go look, I've attached the invitation to negotiate, the sample contract for the underwriters, because we're still doing the final negotiations on the contracts. I think about half of the firms have signed the contracts, and there's a couple more that we're still working with. So the contracts are not, we've got a standard contract. Some of them have small issues that we're working through legally. And with the underwriters, in truth, the contract they care most about is when we do the certificate purchase contract and the offering statement. This is really a contract that deals with the fact that we have pre-selected them as underwriters. So there'll be separate contracts for each individual transaction that will come before the board. And then the contracts for the attorneys are also attached. So if you're interested in digging into those, I wasn't planning to bring those up and go through contracts today, but they're there if you want to see them. Okay, so I do want to be able to tell the board that you all have approved the selection of underwriters and attorneys. Is that, do I see nods?
Yes, Bob, so moved. Or if you moved it.
Okay, very good. So the next item is going to be we're going to talk about underwriters. We're also going to talk about a proposed COPS issue. And I'm going to let Laura get started with the market update. I think she's got a couple of slides. And I'm going to ask Jonathan to come do his magic to make that look better on the screen again. Sorry, one of these days you'll have to show me exactly how to do that. Okay, perfect, thank you.
Good morning. So as Leanne said, I'm just going to do a really quick market update for you. This is kind of in line with what Richard was saying, but this is off BVAL, which is what we price the district's bond transactions off of, that we watch. And the graphic on the left, the blue bars are the range over the past 10 years, with the yellow up at the top is where we currently are, and the average is the orange diamonds towards the below. So while rates have increased slightly, we're still within those 10-year averages. And the chart on the right, you'll see the dotted yellow line was where we were a year ago. And the blue solid line, which is kind of hidden under the orange dash line, is where we currently are. So, as Richard had mentioned, that inversion has been moving out. And so we are kind of seeing the typical curve that we've seen in the past that we're accustomed to. And I did just want to mention as well the rate spreads, while rates have slightly increased some, the spreads have tightened. So when you actually go to price, the credit spreads off of the BVAL rate has decreased some. So rates are still very attractive for municipal issuers at the current moment. So as Leanne had said, we are going to talk about the underwriting team that was led through a procurement process. And as she had said, the two seniors are Bank of America and Raymond James, with the co-managers being Morgan Stanley, JP Morgan, RBC Capital Markets, and Jefferies. And we talked about the utilization of this and kind of wrote out general guidelines of what we'll be using when we select the underwriters who will serve on negotiated deals. As Leanne had said, if we do a TAN, which is through competitive, that's open to anyone in the market. If there's a bank loan opportunity, again, that's something that we would help bid out to a whole plethora of banks out there. And so this is just specifically for negotiated financings for the district. So regularly planned financings, which would be new money, restructuring, straightforward refundings. We would utilize one senior manager, so either Bank of America or Raymond James. And then the co-managers would rotate through the list, starting with the highest ranked and moving through. So just to go back, we did list these in order of ranking of the firms so that you have a sense of this. So B of A was 1, down to Jefferies was number 6. So that is in order of the actual ranking.
At that point, if you're not a senior manager at this deal, you become a co-manager?
That's correct.
No. So it's going to rotate between the two top firms. So on this upcoming transaction, Bank of America would lead and the co-managers would come in. On the next transaction, Raymond James would lead. Bank of America would sit out and the co-managers would participate.
Candidly, I don't know. I don't think so. I can't, if you've got two senior managers, you want,
One of them would be senior,
and the other would be a co, yeah.
When we've done this before, usually the two seniors just rotate back and forth. And then we rotate the co-managers back and forth. So the,
Well, if y'all, if that's what you practice.
Well, is that sensible? What do you think, PFM?
Well, if it's the preference of the committee, I mean, we can definitely do where the senior that's not running the books would serve as a co-manager on the team. And then we would rotate through the other co-managers as well. And what we have on the bottom of this is kind of the general guidelines based on size, how big the team would be. So, you know, between 150 to 300 million, for example, there'd be a total of 4 firms. So one senior who runs the books and then 3 co-managers. And so we definitely can adjust so that a co-manager is, the senior that's not running the books could serve as a co-manager on the deal if that's a preference.
What do you all think?
Well, I certainly think the co-senior manager should be a co-manager if he's not running,
I
if
do
he's
too.
not out of the loop. I mean, if he's not running the books.
Why penalize him for being a manager?
Yeah, exactly, yeah. I mean, he came in second, so, you know, what the hell, you know? Or,
We will make that adjustment. In general, though, we did kind of set up based on the size of the team, how many firms would participate in it to make sure that the allotments and liabilities, you know, that the participation is still strong for each of those. You know, we don't want to dilute the team so much that co-managers aren't motivated to serve on a transaction
You want
as
to
well.
reduce the
I
team?
agree with that, for sure, but I mean, it seems to me that you picked a management team out of,
To continue with the
participate.
top guys?
Okay, perfect. We will make that adjustment. And we did just want to mention as well, potential adjustments moving forward. You know, the district would continue to reward senior and co-managers that develop new financings. So if there's something that's out of the norm of a new money or a current refunding that's coming into the market, that they could come, you know, a potential forward refunding in the public market. If swaps were ever back up there with any, you know, we want to reward firms for being innovative in their structurings that would differentiate them. And that's also to say as well, if a firm is underperforming for some reason, they could rotate out of that senior spot. A co-manager could rotate in to be a senior. If staffing changes occur within the firms, that could also result in there being a rotation of the firms out there.
Who makes that decision?
that's going to be a recommendation from PFM, and then the decision would be made by me, and it would go through the school board. Every time we do a transaction, the board is approving that. And we do bring those transactions, every one of them comes to the finance committee as well. But if you think about it, in the last contract, City ran a deal and did a great job, and then they left the market, and they were a senior manager. I wouldn't want City running a deal right now. They're out of the market. So we need to have that flexibility to adjust and adapt. There's lots of movement with underwriters, has been for years. So we want the flexibility to be able to adjust and adapt.
Well, I think you've got a much stronger team here now, because these people, at least for what little I know about it, none of these people are gonna get out of the business
Right.
anytime soon. So it would be unlikely. While they were, in the past, we had
Right.
a lot, we've, in the past, not only here, but elsewhere, you see that there are a lot of, two guys and a pencil, showing up as a co-manager and getting a check, and that was about it. Here we've got people who actually participate in the market on
And
an
we did
ongoing
look
basis.
as well, when we were going through the procurement process, as firms who were increasing their staffing, where we've seen a lot of firms maybe decreasing their staffing and support coverage in Florida. That was a consideration that we were looking at, is who are those that are investing, sort of that showing that they're willing to commit into, what they're producing for their teams in Florida. So that was part of the discussion as well.
Listen, y'all know more about it than any of us do, so we certainly value your observations, but I do think that, letting the other co-senior manager,
And we can
Just
make that
right.
change. The way the procurement was done, it gives us, we pick the firms, but then we have a lot of flexibility in how we use them.
Right,
It's a
okay.
good idea to have our game plan in writing so that all the underwriters know how that's going to
Yes,
work.
I agree.
And then if we need to change it, we'll change it. And we'll probably bring it back to the committee if we're making a change in the underwriters that's significant. But we'll bring, for the last contract, we were juggling 11 firms and keeping track of who was on which deal. This will
Who
be
was
a lot
still in
easier.
business.
This one will be a lot easier, but we'll still have a list of which firms are on which deals.
Right.
So if there's any more questions on that, we'll move on to the refunding opportunities. Okay.
I think I did mention this the last meeting. We had a lot of bonds issued in 2015, and it's 10 years later, so it's time to look to see if they're eligible to refund, if it makes sense to refinance them, and it does.
So we're currently looking at 3 different series. They all have a call date of August 1st of this year. For any maturities outstanding after August 2026 are eligible to be refunded this August. So this just shows the original par amount for each of these on the series 2015 B, C, and D, and the current amount outstanding and what would be currently callable. So in the 2015 Bs, there's 71.17 million that's callable. In the 2015 Cs, there's 62.97 million that's callable, and the 2015 Ds is 159.07 million that's callable. So this will be a very significant refinancing. The final maturities on each of these, I did want to point out, in the 2015 Bs is 2031, and the 2015 Cs and Ds are 2032, and those would remain the same. We wouldn't be extending any maturities on this. And so this slide just shows you, what we're looking at as a potential closing date, which would be in May, the redemption occurring in August, with current market rates, where we're sort of seeing that true interest cost assumptions that went into this, which are still conservative. But overall, it's 6.8% net present value savings, or 21.2 million, but we did break this out by series so that you can see that there's healthy savings within each of these refundings. But we would aggregate this and just issue it as the 2025A certificates of participation to take out each of these 3 series for the eligible par that's refundable.
Any thoughts on that? One series for all 3? One takeout for all 3?
Yeah, we usually combine them, and we've done that before. We roll them all together. The folks in my office, it gets cumbersome because our trustee still tracks them back to the original ground lease. So PFM usually gives us a chart that breaks it down by individual deals, so we can figure out where to put which account everything goes into. But this one will be the largest deal that Palm Beach Schools has ever done. It's been pointed out by several of the underwriters.
How big is it going to be?
Excuse me?
How big?
293 million is the amount to be refunded. I think
Good.
the last I saw, the par was about 272 million, but that will depend on market conditions and what kind of premium we have.
Right.
Sounds good.
So I'm looking at that $22 million worth of savings and figuring out how we're going to use that. Our construction department already has their eye on it and things they'd like to add into the capital plan. So we'll be adding that in. This transaction will be going to the school board. You can go on. It'll be
Yes.
going to the board on April 23rd. At the same meeting, the underwriters will be going to. We'll be approving them all at the same time.
That's really cool. 22 million out of thin air,
Yep.
basically.
Yep.
Serious money.
This might shift a little bit. We are still going to go to the board on the 23rd, print and post the POS on the 24th of April. The pricing may be adjusted depending on what's going on in the market. The Fed is meeting the first week of May, so we're taking all of that into consideration, but the plan is to then close in May at some point. So price end of April or early May to lock in the savings and just be flexible with the timing on that. Obviously, since we are trying to capture savings, time it as best as possible. And this does have a recommendation that we would like from the committee as well to consider moving forward with the current refunding of the Series 2015B, 2015C, and 2015D. The parameters would be a minimum net present value savings of at least 3%, and that the final maturities are not extended beyond the current final maturity.
Sounds good.
Excellent. Yes.
You're looking for a motion?
Yes,
Motion.
please.
I'll move approval of that proposal as described.
Thanks, Jack.
Second.
Seconded. Any comment? Any issue? Motion passes.
Okay. So we are already working on the preliminary offering statement. We've already received that from Disclosure Council. We've been working on it. In my office, we'll be sharing it with other departments within the school district for review shortly. I'm supposed to have a final first draft ready sometime late next week. So we're moving ahead with that. That does take some time to make sure we have all that information ready. We'll be talking with rating agencies. We'll be doing all
We
the
get to
different
approve
steps.
that finally before it goes,
This is your approval for the
is it.
transaction. This is it. It'll be going to the school board in April.
do we
And
have
then-
any minimums here that we?
Well, we have the minimum present value savings of at least 3%.
Which, yeah, so, and currently, all of these individually are well above the 3%, but we would be looking at that by series. So say the 2015B, which is at 5.67, if the market moved significantly away, then, that would be a conversation if it dropped. But these
So
are
it's
very
really up to that dollar figure, up to the
Yes.
total dollar figure,
Yeah.
depending on the interest rates and the different series.
Right. I mean, and this information, I looked at this, and then I looked at numbers that I got yesterday. They're slightly different. They're going to change every day. They change middle of the day. So that timing of what's going on in the market, avoiding the week the Fed is meeting is I mean, sometimes, that's, PFM has got a team of people that are running a desk all the time and talking to, in this case, the senior underwriter is going to be Bank of America. They're already syncing up. Even though their contract hasn't approved, we're already working on it. Because we expect the board would approve the recommendation. They very seldom, actually, I've never seen them change something that's been gone through an ITN. They have to have some very strong reason to change that. So I have full expectation that it'll be approved. So we're already running with that, getting ready. But nothing will actually happen until after the board approves the transaction. It's just behind the scenes work.
Thank you. Well, so this committee's finally flexing its muscles.
I think y'all have done a commendable job. Congratulations.
Good.
Thank you.
Nice going. Well, Leanne, you're super dupers. Thanks for your finance.
Yes.
You have the committee's approval,
Yeah,
but
you're
for curiosity, from the market perspective, will this be ho-hum, or will this be a big deal? Or what?
There are always much larger deals. This is
Right.
big for us, but it's not the biggest throughout the market.
Yeah, and we've been seeing lately with Florida schools in general, even new money needs, just because of construction costs. 300 million is a larger transaction, but it's not unheard of from what we've seen. So it's on the larger side, but with the structuring of this and the different block sizes of the maturities, the underwriters will go out and easily find investors that are attracted. We were just in the market earlier this week with a different school district, and there was well over $500 million of orders that had been put in for a much smaller deal, so the investor appetite's out there. And so I think that, that's part of the flexibility of when we actually price to make sure that the market is as favorable as possible as well.
Good.
Yep.
Thank you.
And when we actually price the transaction, we get all kinds of reports on numbers, and sometimes I send those out if y'all are interested, and I know Mr. Dumars has seen those many times, and Mr. Miller, Ms. Moore, you've all seen those. Happy to send those out and share the results when it's done. That day, I've got a team of people that are sitting around watching the computers to see the sales coming in, to see how, if it's oversubscribed, which ones are short. So it's a busy day when we do that sale. It's a lot busier for the underwriters and the teams on the street that are selling the bonds, but we're certainly paying attention to it when it happens and happy to share that results. But going to the size, the most recent high school in the state that was built is now over $200 million to build a high school. So the construction costs have gone up significantly, and then we're having to borrow more. So a $300 million deal is a high school and a middle school, 2 schools. We used to be able to do $100 million and build 6 schools. So it's changed a lot in the time I've been here.
Exactly.
They're getting much nicer schools, too.
Yeah, well, the last school we opened, the last high school we opened, Garcia, Dr. Joaquin Garcia High School. If you haven't had a chance to see that, it is a beautiful facility. You know, years ago, we took the committee out and we had a meeting. We did a field trip and took you to see a school that was ready, that was going to be open, and it wasn't quite done. We went to see John and Leonard High School was under construction, and that was a long time ago. If that's something you all are interested in, want to see one of the recently built schools, I can arrange for that to happen. Maybe if we manage to have a meeting that's happening on a day that we're open, but schools are closed for a teacher workday or something, we can make arrangements to say, we're going to meet here, have our meeting, and then everybody can take their car and give you directions to see the school. Happy to do that. Or there's been a couple of videos on some of the high schools, but actually going there and being there, and that high school has a very much a college feel. It's one of the most beautiful schools I've seen.
You all in for that?
It's interesting to see what they do, I'll tell you.
Yeah. And we can set that up. There's going to be the school under construction, that we've got 2 schools under construction right now. Winbrook, we're replacing Winbrook right now. That's going to open in August. And we're also building the new school that's out near the Arden community. It just got named Saddleview Elementary. And that is way out west. It's near Lion Country Safari. That school's going to be opening in August too. So it's easy. They'll be doing tours. I'll take my staff out to see the new Arden School when it opens. I've got a team in my office that are actually reviewing all the bills related to construction. So I do investment debt and the capital budget. So we take them out and we go, I want to see the switch gears and the generators and the things that cost so much that nobody else gets to see. And I walked in and said, I want to see the switch gear. And they said, you can't go in the room. It's electrical. You can't touch it. I said, I just look at the door. I want to see what it looks like. And it's your breaker box at your house, but at a school, it's a wall. It's a big, giant electric panel. But it costs a lot of money, and it has to be ordered a year in advance to make sure it's here in time. That's one of the long lead items. So I wanted to see what it looked like.
Only
So-
Leanne, that would.
Yeah, that's me. But, you know, we pay the bills, so I wanted to see what those things look like. So you can let me know if you'd rather see the high school or see the school that's going to open, because we can arrange for either one. It's easier getting into the school that hasn't opened yet, because they're gonna be there. There'll be construction crews there. On my understanding, they're gonna have substantial completion in May. So at our meeting over the summer, we can certainly arrange to go take a look at that one.
I think I'd prefer a high school. I don't know about you all.
When the high school is open and done, and
Yeah.
that high school has a blue football field, and it's artificial turf. It's Carolina blue. We
All
had to
right.
get permission from the University of North Carolina because they had
All right.
trademarked the color.
Fantastic.
So we can make arrangements for you to see it. It
Blue
is a
and white,
beautiful
huh?
facility.
Nice.
Okay, and I think that is the end of our meeting. I do want to bring up the agenda again, if I can grab the right document. On that second page, it does have the next meeting dates. The next meeting is May 23rd, and then August 22nd. The August meeting is right after school starts. Oh, there is one more thing on the agenda. I just skipped right over it. The last thing is we do need to elect a chair and vice chair of the committee. We haven't done that yet. And I did go to the school board and got permission for, there are chair limits there are term limits for the chair. So it's been no more than 4 years. This committee has in the past said we would like to have the option to pick anybody, so I already went to the board and got permission, so you can select anybody in the committee to serve as chair and vice chair for the coming year.
Right.
By consensus.
Well, we actually have to have a vote for this. It can't be consensus. So if somebody can make a motion and second, and I can say, I saw a motion from Mr. Elmore and a second from Mr. Warner. All in favor?
Aye.
Aye.
And any opposed? None? Okay, so vice chair. Mr. Dumars is currently the vice chair. He was elected when he wasn't here. But you're here today. So
that the
I'd
way it
ask for a
always works?
motion for vice chair.
You okay, Paul, with that?
Mr. Warner, no, sorry.
No, I've been in so much since
Okay, so can I get a motion for somebody else to serve as vice chair? Or if somebody wants to
Mr. Warner.
volunteer? Mr. Warner?
Warner, move, so.
I will again.
Okay, a second?
Second?
Second,
Okay.
yeah.
All in favor?
Any opposed? Okay, so Mr. Warner will be vice
Ayes
chair.
have it.
So thank you very much. I appreciate that. And that does bring us to the end of the
Love
meeting.
you there, boy.
That does bring us to the end of the meeting. So
Thank
do
you.
you want to
Thank
call
you.
and adjourn?
Yes.
Nope. Thank you very much for everything.
Okay,
As
thank
usual.
you all very much. Have a great day and a great weekend.